Alright guys, I'm going to show you some research I've been doing the last couple days, linking the real estate data indexes to the stock market. I haven't really seen this done out there. Kind of stumbled on this, so let's take a look. We're going to use the NAHB, National Association of Home Builders Housing Market Index. Real quick, it produces this index every month to gauge builder sentiment. It's based on a survey, and builders are asked to talk about or rate the local market conditions, provide timely information about current housing conditions, as well as home sales in the future. Rating three aspects: current sales, expected sales, and traffic of prospective buyers in new homes. All right, so let's take a look at this. It's basically, let's open up the Excel file that I made here, and we've got some color coding, a little OCD, but I think it's pretty cool. So let's take a look. Here's the grays are market crashes. That's when the crash started. So here's October of '87, pretty big crash. Here is another October of 2000. That's kind of the market NASDAQ breakdown and the subsequent .com bust. Kind of got started October of 2000. Then we have the January of 2008 global financial crisis. And you'll see that leading up to that, new lows in this housing index, NAHB housing index, happened. Okay, don't worry about the blue right now. Another thing I found out, if you take the high within the last 3 years, okay, so there's 65, 1998, it's 78, 2005 was 72. So we'll talk about this market in a minute here. If you take the high and get the low, this is when the crash happened, coincidentally, you get about a 23% difference here. All right, so you got 65 minus 50 is 15 points. That's 23% loss of the high in the survey and the low in the survey before the crash happened, stock market crash. Okay, over here, 2000.com stuff, 78. That was the high in the index. That was over here. The low was 58 right there. And that's a 25.6% loss. Now here's the realestate.com, or excuse me, real estate global financial crisis deal. A lot of red. Okay, the high was 72 in 2000. That's probably arguably the biggest year before the housing crashed. The low is 18. This is again before the crash. That's a 75% loss. And I've got a note here that this was all fueled. It was primarily housing fueled, easy credit, easy mortgages. So 75% loss, that's kind of a big deal. But the stock market didn't crash till January. All right. So my point being is this: the last 2 or 3 market crashes, big crashes, housing deteriorated from the high 20, let's call it 22% or more before the stock market crashed. All right. So operationally, how do we make this work? So we take the highest high, all right, of the last 3 years, starting today. You take that high and you multiply it by 0.78. That's 22% loss. And that gives you a number. That number is our red flag level with this housing stuff. So let's come down. We're in 2018, right? Presently, let's take 3 years, go back 3 years. 3 years ago, 2017, the high was 74. 3 years before that, the high was 69. 2015, the high was 65. So 69.74. So if we go back 3 or 4 years, the high is 74. All right. 74 times 0.78, representing 22% loss, is 57.7. Let's round it to 58. So 58 on this index is a red flag level. Now remember, I also said a new low on this index, which in and of itself is significant. The new low, last 3 years is going to be about 50. Well, I mean, there's our number there, 58. So I kind of stumbled on this just now. So 58 from a new low standpoint is a red flag. Go back to 2017, the low would be 64. 2018, 68. So, you know, if we break 64, that's kind of a yellow light. 58 is a new low. 58 is also 22% loss. So, you know, that's kind of my hypothesis, my theory. 22% loss off of a high, a 3-year high, is a red flag. And this is leading a crash. All right, this doesn't mean crash is going to happen tomorrow.